As an introduction, just before introducing the panel, the panelists, we had last year, so 2021, a record flow into funds globally. So we are talking about 2.4 trillion US dollar, out of which 600 billions are invested in sustainable funds, so sustainable finance. ESG is well understood and integrated, but we are going to talk about impact today. And impact is maybe less easy to understand and to integrate in or to put in action. European SFDR classification, the situation is quite clear. We have Article 8, ESG, Article 9, impact. But for the time being, it's only on self-declaration. So that means that if you want to launch your own product, your own fund, you put that into the prospectus and it's good, so far. The European Commission will work on that, and the good sign is last year Morningstar in December, they listed 1,200 funds from Article 8 to Article 6 because they were not ESG at all. So that's the current situation, the current environment, and I want to talk about these topics with my panel. So I will introduce you to Lionel Aeschliman. Lionel Aeschliman is managing partner. Yeah, is a managing partner at Mirabaud and responsible for Mirabaud asset management. Maxime Perrin is head of sustainable investment for Lombard Odier investment manager. And Dominique Habegger is a long-term and long-time senior asset manager managing impact funds. So I will start with Dominique, just briefly to explain us the difference between ESG and impact.
Thank you, Laurent, for the introduction. Thank you for inviting us on this panel, and as the day will be about impact, I'm sure we all have a little bit different definitions. I'm sure we'll agree on most of them, and very often in the financial community, a good way to explain the difference between ESG, sustainability, and impact is to talk about the business models, because we invest in business models. And from an ESG perspective, I think what's a striking difference is that you look at the impact on the business model. You're worried about your investments. Whereas in impact investing, you look more from the inside out. You look at the impact of the business model on environmental and social conditions. And that's not the only way to define impact, but I think as we have an investment crowd here today, it's a good way to kind of make the difference between ESG and sustainability. There are many others, I'm sure, that we will address.
Maybe just a question on that. Would you say that ESG is well defined right now, but impact is less defined? There is more room for interpretation with impact than with ESG?
I think actually impact has helped to better define ESG as well. There was a lot of mixture and controversies around ESG ratings that give an A rating to Tesla and the other rating giving a D rating to Tesla, depending on you look at it. And very often, it's if you put your ESG lens on, you will look at it differently. It's obviously the same company, but that's, I think, a positive that impact is a bit segregated from ESG today.
Maxime, when we were preparing this panel, you mentioned us that impact is basically a subcategory of sustainable investment. Could you explain a little bit what was your thought when you said that?
Of course. Hello, everyone. What I mean by that is, if you think of sustainable investment as the taking into account non-financial elements, externalities, to use the economic term, in your investment decisions, then you can do that in all kinds of ways. You can do it by, simply excluding certain activities that you think are beyond the pale. You can do that by promoting certain practices, social practices, environmental practices in all the companies that you invest in. You can think about it through thematic investing by saying, I will look at externalities by looking at positive externalities of, say, clean energy. All that can be just, defined as an approach to sustainable investing. Impact investing, as Dominique rightly put, or certainly I agree with him on this. I'm sure there's other opinions, but from our point of view, impact investing is specifically investing in companies where you have the intentionality of changing for the better an environmental aspect or social aspect. So it's a much smaller section than sustainable investment on the whole, and it's geared towards an outcome, a specific outcome that in each individual company that you chose, or company, or debt, or private equity shareholding. That you define a priori what the impact is going to be.
Yeah, thank you. Lionel, we went as an evolution from ESG to impact, and by the way, did we forget that we are here to make business, to do business, to make money for our client? Because all these type of things are very good, but at the end, and you might know that as a managing partner of Mirabaud, your clients are here to make money.
Yes, good morning. Thank you very much, Laurent, for the very good question. It's a bit early in the morning to talk plainly about making money, but it's certainly a topic which should not remain as the elephant in the room, as we say. How should I say, 10, 15 years ago when we started at Mirabaud to implement and to document and to formalize the responsible investment processes, responsible investment was kind of an oxymoron, so two words that didn't fit well together. And when I talked to our fund managers, telling them we should, document and formalize the integration of extra financial criteria in your investment processes, which you do in many ways, but without knowing it sometimes when you talk about good governance, good management, about sound and healthy risk management before investing, they were telling me, Lionel, that's nice, that's good, but don't distract us. Our mission is to generate the best risk-adjusted performance for our clients. And our clients are pension funds. That is, we manage the money of future retirees or savings from banks or from other insurance companies. And we need to generate performance. They have, fiduciary duties, and this is the objective. Now, 10, 15 years later, we are moving towards from an oxymoron to hopefully a pleonasm sometimes, where investment will be per se responsible always, in that it will have a broader perspective and integrate not only these financial objectives, but also the extra financial objectives. Why? Because these extra financial objectives have an impact on performance. I mean, poorly managed environmental, social risks, or bad governance, poor organization, not managing properly negative externalities or enhancing positive externalities can have impact on the share price of a company you buy.
Thank you. Maybe a word, I don't know who wants to start, maybe Dominique, regarding the evolution of your company, your own company, in that field of ESG and impact. We know each other for long. For this impact product, you manage since 20 years or even more. But how this or your company evolved during that time? And maybe the same question for the other panel.
Yes, the main evolution, I would say, is that in the early days, investment processes were pretty much focused in trying to do a lot of ex-ante work to know in what you invest. Now, this was the rule of the game, working with ESG ratings, and this has greatly evolved today thanks to the fact that ESG has become a key debate and a key topic for most asset managers, is that raise the level of maturity of the market over the years. And we need today to differentiate by asset class, the different types of approaches, the different type of strategies. There are 6 or 7 well-established, well-known ESG and impact strategies, and pretty much like in the hedge fund industry, which has matured much faster than the ESG one. Hopefully it will not go down the same way. There are blends of those strategies, and depending if you invest in bonds, in equities, in private equity, in infrastructure, obviously the approaches will be different. And I think that's the main way to look at this. And we might discuss later in this panel what is, for a lot of us, the main asset class, which is equities. That there are probably has been the greatest maturities in equities today.
Thank you. Maxime, yeah.
You want me to answer the same
Yeah.
question? Okay.
Please.
So, Lombard I think had a pretty standard, beginning to ESG, which is like the mid to late 90s. They started having ESG scores being either calculated or adjusted from databases, and then I think the move, UNPRI acceptance, then the work with different organizations, Swiss and international, and then there was a major acceleration in the 2010s, and then over the last couple of years, with the conviction that transition, and particularly climate transition, was an opportunity of the magnitude of the digital revolution or the industrial revolution. That's been really the journey that Lombard took. In terms of impact investment, strictly speaking, as it was defined earlier, we've done it with green bonds, we've done it with private credit so far. And we haven't, there's plans for private equity on specific impact measures, but it's still, because of the specificities of it, it remains small portfolios on the whole in asset classes that aren't necessarily as liquid as the broader sustainable range.
Maybe same question for you, Lionel, as well.
Yes, thank you, Laurent. It's how should I say, it's a journey, and I think we have to show a lot of humility and modesty in these topics, because things evolve. Mirabaud, of course, established in 1819. We represent today the managing partners, the 7th generation. So we had the intuition or the DNA that the very corporate house, and like Lombard or others, is in a way a sustainable house, because it has been working always for the next generation. When I joined and asked my partner, so what will be my job description? What do you want me to do? They said, we want you to transmit the group to the next generation, healthier, sounder, stronger. And I said, yeah, but what else? They said, well, that's it. That's the important thing. So having this long-term view when you're privately owned, family-owned, is somehow part of your DNA. So that's at the firm level. Then in terms of investment, we are an investment boutique. A little bit, I think we did the same similar journey to many of you, and definitely I think Pictet, Turrettini, or Lombard. We started with, around pretty much governance, making sure that companies we invested in had a solid and a healthy governance. That's what we would call the Anglo-Saxon way, stewardship, code of good corporate governance, etc. And the rest was good risk management. So ESG, putting the ESG came through the UNPRI in 2010, and then moving and implementing that in the process, bringing proof points around not only the G, but the E and the S, showing how it can generate value, organizing the investment teams. For the financial elements, they do their own analysis, rely on Bloomberg, brokers, Reuters, other data providers. For the extra financial, in-rate, Sustainalytics, all the other data providers. Then moving to developing in-house models to challenge this and just follow, the databases as indications, but not as the Bible or the truth. and then eventually putting all our funds under Article 8. As you said, it's a self-certification. We have labels. We got, about a third of our funds with labels from the French government, which is an independent label. And then we thought a little bit about the impact. That's a little bit the next step, no? And we came to the conclusion that for liquid funds, listed equities, fixed income, except for the climate transition bond fund, where we have an Article 9 fund, impact is pretty much a topic for private equity. So our private equity funds are all impact because of the element of intentionality and additionality, more importantly. For private equity, we can show the additionality without our money, without the capital we bring, without the contract and the elements we put in the shareholders' agreement in the companies we invest in. I mean, we can have, these companies would not even exist probably, so the additionality element is clear. For listed equities, it's maybe another topic. It's a little bit more complex to do real impact at this stage, I believe.
Thank you. We can't have a panel session about impact and ESG without talking about the regulation. So, Maxime, could you elaborate a little bit regarding the SFDR regulation for impact fund, where the impact funds are positioned in this SFDR Article 9?
So I wonder the short straw on this one, I can see that. So obviously if you want to think about the regulation in a simple way, think about it as the European Commission tightening the screw gradually to get what they want. What they want is a flow of money towards the Green Deal. So they start off in last year asking all funds to self-register. Article 6, Article 8, Article 9. Article 6 is you openly say you're not taking into account ESG metrics. Article 8 says you take into account sustainable aspects in your management and you can demonstrate it. And Article 9 says that your fund or your strategy or your product is aligned with a specific sustainable objective. Clearly, since it's self-registering, as someone once told me, it's like turning up at a martial arts tournament and saying you're a black belt in karate. It only involves yourself. So if you're not, no one will tell you until you're actually on the tatami trying to defend the fact that you've said you're a black belt. So a lot of people, as Laurent said, a lot of funds have already been declassified based on the knowledge of the consultant or whatever who says, actually, you're not seriously in Article 8, you're not seriously in Article 9, please, go back to the changing room and put a color belt that's appropriate to your skills, in a way. Because of the impact investments targets, its objective is really to have a measurable impact that's intentional on a specific aspect of the environment or of social stakeholders. That is because it's specific, because it's one objective. It is clearly Article 9 for everyone who looks at SFDR classifications. Because impact investment is part of Article 9, one should not come to the conclusion that all Article 9s are impact investment. It is not true, in large part because of the question of measurability. Impact investment, at least the way we see it, has the additionality, as Lionel mentioned, the measurability, which it takes the form of reporting on metrics that have been already defined, and intentionality to show that each company you're investing in, is actually its intention is to have this positive external impact. That is not the case for all Article 9 funds. You can have a fund that's a strategy that is clearly aligned with a specific sustainable objective. Take climate change, or take social behavior, or you can look at all kinds of outcomes that you can play or you can invest in without each individual company that you're investing in reporting on a measurable metric that is aligned with this. So the quick answer to your question is impact investment is Article 9. Article 9 is not necessarily impact investment. I could have said it shorter, I'm sorry.
Thank you. We are coming to a chapter where we can basically discuss the performance of the impact. So a couple of years ago, being an SRI product was an excuse not to perform, or could have been an excuse not to perform. If we want, altogether as a financial community, that the impact investing will be a success, by no means we should repeat the mistake we did in the past. So we have to perform, and it's not performance against impact, is performance of impact investing and as a mindset. Could you maybe, Lionel, elaborate a little bit more about this combination?
Yes, this is a very complex question, actually, and in reality, you have a whole array of products, of objectives, of targets, including, of course, social, environmental targets, but also financial return targets. And I think that it all depends at the end of the day on the objectives of each investor. As I said before, many years ago, people would see impact or ESG as a distraction towards the generation of good performance. Now this is no longer the case. However, it is very possible that an investor decides to relinquish some of the financial returns to attain higher or different social or environmental objectives. I mean, if you take the whole array on the far left, or on the far right, this is not a political statement, you have philanthropy, and on the far right you have, the good old fund manager who just cares about short-term profit and companies making as much money as possible on the short term. This is no longer now the model at all, but philanthropy doesn't target any kind of financial return. Then you have impact, and you have different kind of impact. You have what is called concessionary impact, where investors do accept to have a lower return than they could get without taking these elements into consideration. Then you have impact targeting market rate return, so to say, and there is impact targeting above average return. And this is what we, again, but with humility, try to do in private equity, where we do believe that impact can bring additional performance, better risk management, the intentionality and the additionality can bring better returns for the investor. And not only on the short term, but on the long term. If you invest in a company that has a positive impact and targeting good impact for objectives for the long term, it can increase its goodwill, its value, its reputation, its image, its brand. So creating value for the long term in terms of goodwill as well.
That's what you as an asset manager wants to provide. Is it something that you perceive that your client needs or wants to obtain from you?
How should I say? I think many clients are lost. And I understand why, because ESG was something kind of a distraction, and now it's everywhere. It's a bit similar for impact. We have loads of issues of definition. There are very few third-party independent certifications, or there are labels, and we, in France, in Switzerland, in Luxembourg, in the UK, and at the EU level, in the coming, they are being prepared, etc. So many clients are lost, and they ask the question, why? I mean, what is the objective? What is the financial objective? What is the impact on my financial return? I, as a pension fund, I have a duty, fiduciary duty. Will it enhance or will it diminish my financial returns? So it's a very key discussion, and it's very clear that we must agree fully on what are the client's objectives and what's his relevant benchmark. Because you cannot measure an impact investment against a benchmark that does include companies that you should exclude, for instance, based on your client wishes and desires. So, then there is another big issue, but it's a big topic. I don't want to take too much time this morning. It's the issue of data quality and data disclosure by company. Even on the accounting side, if you look at the traditional accounting, the IOSCO and the other standards, international accepted standards, they all take into consideration balance sheet, P&L, and they took into consideration ownership, but you don't find in the balance sheet or in the P&L negative externalities, environmental damages, or the use of the ecosystem, or the reduction of biodiversity. How do you translate these elements into tangible account elements that can be disclosed or accounted for in financial statements?
Thank you. Maybe talking about a couple of concepts linked to impact investing. So we will talk about additionality. You have heard about it. Additionality, intentionality, measurability. All these concepts are good, but I think it's worth to pay a couple of minutes regarding these concepts to explain what we are talking about. If we start with additionality, Dominique, could you tell us a little bit more about that?
Yeah, I think it's the key, one of the key components of the impact investing. It's not an asset class, but theme at least. Because it allows to differentiate better what you can achieve in different asset classes. And very often I see, in fact, the term impact investing linked to listed investments. And there is a big confusion in people's mind, and I hope the events such as this today helps clarify between the fact that you invest, that you have the impact on the investment or the impact of the company. And you see a lot of impact fund just because you invest in a renewable company is okay. The company has an impact, but you as an investor, if these companies don't necessarily need your capital, especially if it's listed equity, then your investment does not necessarily have an impact, which is very different from the private equity aspects where those are really companies that need the capital in most cases. Now, it doesn't mean that you cannot achieve additionality in listed equities. And there is one of the elements of the ESG strategy called active ownership, which is a lot based on the engagement part where you can dialogue, where you can exchange with companies, and you have 364 days in a year where you can do that. There's one day you decide to invest in a company, and there, if it's a listed company, you have a very limited impact, even if you're BlackRock. There's been studies out there that shows that at least 80% of capital needs to flow in or flow out of a company in order to have a relevant impact on the cost of capital of those companies. But if you engage with a company, if you as an investor come up with credible and intelligible recommendations based on research, based on gaps that you can document, and that you can discuss that in a company, then you have an impact if the company starts listening to you. Why? Because impact is also about doing an investment that has an impact, but if you wouldn't have done the investment, the impact wouldn't have happened. So if you decide to sell your Nestle shares and buy Danone shares, you're not changing anything. But if you can conduct engagement in an efficient way, and again, it needs to be measured, it needs to be documented, because it's very easy to see that you dialogue with companies, and a credible document is showing that you're not necessarily succeeding with all of the companies, but you're trying, and you can also showcase the positive impacts that you achieve. And that's a very, very important distinction to make in listed equities. ESG does not equal impact. Really, to generate impact, the pretty much only option that you have, except in very, very small cap, is to engage with company ex post and to try to create a differentiate as an investor.
Thank you. Maybe Maxime, regarding intentionality and measurability.
Measurability, yeah, I'll be quick because I've already mentioned them a few times, but no problem. I'll maybe to make it more telling, just use an example. Imagine that you invest in a a green bond fund that has impact pretensions. What you're basically saying is the intentionality is reflected in the fact that the use of proceeds of the debt is ring-fenced for specific projects. So imagine that you have a fund dedicated to energy conservation, for example. All the individual instruments in your portfolio will have the intention of reducing energy use. So it could be companies putting solar panels on their roofs, or improving insulation, or any kind of ring-fenced use of proceeds that shows the intentionality of each individual line. That's intentionality, and that's why it's complicated to do it in massive portfolios, because you really have to document, as Dominique said, the intentionality of each investee company. And the measurability, that's obvious, but once a year, at least, you must show the measurement of your impact. In other words, if you go back to the example of a fund dedicated to energy conservation, you have to show for each individual line how much, there's a measurement of, lesser electricity bill, or use of electricity more broadly, is measured on a year-on-year basis over the course of the bond that you purchased. That's the two other aspects in addition to additionality.
Thank you. Maybe in interest of time, we'll speed up a little bit, but one of the key question is impact. Is it possible to implement impact investment in listed equity? Because we saw that it's obvious that in private equity we can do something, we can really have an impact, or all this measure are well done for private equity. But in listed equity, what do you think? Who wants to?
Yeah, well, I addressed the theme before, and it's really important because the impact investment world was really not coming from listed equity. It came from private equity investment, from microfinance. Those were a direct impact, and today, obviously, this has become a very important buzzword. And for a lot of people probably in this room, equity is maybe the largest asset class, so it's quite tempting to sell you the new buzzword. But again, if you really go down and nail the various definitions of what impact is, it will be very difficult to justify that you, as an investor, were able to diminish the cost of capital of a renewable energy company that you invested by just buying their stock. And that's what you need to prove if you're trying to do that just based on your investment. And I say good luck. So again, the ex post work that you can do, and that we've been doing for the past 15 years in a very systematic and documented way, to showcase that if you engage over time as a long-term investor, it helps you to get better insights into those companies, into the visions of those companies, and you can also see the companies that are reluctant and maybe are going to diminish, to be extracted by the market over the long term. So it helps you as an asset manager, and at the end of the day, well, it helps to generate track records that thankfully are available today. 20 years ago in the field there was no track record, and today there is a lot of track records of funds going over 15 years, and indeed some of those strategies that were more looking at what can I do as an investor rather than being stuck on is this a good or is this a bad company based on historical data that are not always of good quality. Well, it helps to achieve this good performance that we're all striving to achieve for our clients, and at the same time trying, in a modest way of course, to have a positive impact as well.
Thank you. So it's time for us to conclude. Maybe a 2 or 3 words conclusion from each of you.
Yes, maybe just, again, I think these topics are absolutely key and of the essence. We should not segregate, separate, differentiate sustainable objectives, impact objectives, and the generation of performance. These are not antinomic, but complementary. It's a journey, so it means that we must continue to work. I think the industry has been doing a lot of progresses over the last 10 years, 15 years, but there are an awful lot of things to do. And last but not least, impact investing is not limited to what we used to call the solidary society. It can go to any kind of sectors and thematics. It used to be focused around sustainable agriculture, microfinance, renewable energy, these kind of topics. We in our private equity funds are focusing on, for instance, the textile, lifestyle, luxury brands, real estate development, textile and luxury brands, and all the fashion industry is the second largest polluter in the world. You can have a huge impact in terms of working conditions, cotton, linen products, production, shorter circles, and you can measure and demonstrate that in a very transparent way. So don't be shy and to apply these things to any kind of sectors and fields.
Thank you.
I'd say that there's an understandable cynicism emerging from about ESG because of some obvious flaws, because of sometimes some less than robust reasoning when it comes to exclusions, for example, or misunderstanding regulation, and accusations of tree hugging is also one of the ones I've heard sometimes. But I think we should really realize that what we started off with, talking about externalities, about the cost on the environment, the cost on social cohesion, etc. These things are going to be part of our lives for the next 30 years and more. The pricing of carbon, for example, seems to be, kind of eternally 10 years away from now. It's starting to happen now. The transition means that the transition to an economy that doesn't send 52 gigatons of CO2 emissions into the atmosphere every year means that we're going to have to retool the global economy in an accelerated rate over the next 20 to 30 years. We have to, otherwise, we will have to invest even more to deal with climate mitigation. So I think that when you look at the environment, whether it's through impact investing or sustainability, of course stay critical of methodologies that appear half-baked. But don't lose sight of the fact that what sustainable investment means is actually your money going into a transition that is not only going to be necessary, but is likely to be very profitable.
Yeah, maybe I just want to say a few words about the current events in Ukraine and Russia, which has put into our theme a new topic, which is peace and stability. We were pretty much talking about governance and climate change, and now there is a new topic. And if you think about it, this will be very interesting to follow. Because, again, as an investment, everybody said for many years, if you look at the SDGs, you probably all know the 17 sustainable goals. Their goal 16 is on peace, and all the studies showing the investment flows in all the themes. SDG 16 was the poorest of the poor. Nobody was investing in that, and everybody said this is not an investable theme. But if you look at it from an engagement perspective, look at the difficult decisions companies need to take today if they have operations in Russia or Belarus, and that's a very challenging situation. And that's where, as an investor, if you come in with the expertise, of people that have been working on the topics of peace and stability and advise those companies on what to do. We typically have launched a fund based on peace, and we've been discussing those topics on Myanmar. Obviously, those are two very different situations, but there are some common grounds, and here as an investor, you can have a positive contribution to help the companies prepare to make sure that they know how to deal with situations of fragile countries, fragile context. And that's, again, something which is different from climate change, where people think, okay, just by looking at the carbon emission, you can make a fund that has lesser carbon emission, but it's sometimes obviously important that we all spend the effort to go beyond the labels, beyond the Article 8, 9, and really understand what fundamentally, from an asset class perspective, each asset manager is trying to achieve and how, in particular, the impact is being achieved.
Thank you. Many thanks to the panel and many thanks to you. So let's go on. Floor is yours.